Hi, this is Hans Lysglimt. Today is Friday, November 27th, 2009. And as you can see, I've gotten myself down to a nice and sunny place here in southern Europe for Thanksgiving. But let's look at the markets. And the dramatic thing right now, of course, is that Dubai seems to be crumbling or falling over. The Dubai major investment company has canceled their payments. And as I wrote on the Farman blog today, this is just the first fall of a major institution in the second leg of this major financial crisis, because there are dozens and hundreds of equally important and equally large, troubled, large corporations and assets and balance sheets that are ready to explode any time, and they will. So we don't know for sure if this Dubai thing is going to be the trigger for all these others, but they are still there. This problem has not been resolved. I mean, we've had 30 years, pretty much since the Second World War, of excesses, and this is not resolved just by, a little bit of a downtick in the economy for a couple of quarters and then it's happy-go-lucky again. No, it's not like that. We have a fundamental problem with all the money printing that's been going on for so long, and we have a huge price to pay, and it will be paid somehow. And I predict that the markets will see new lows and that we will turn around and have a new severe, dramatic fall in the stock markets any day. And, of course, this next down leg, this new fall in the stock market is going to be much more dramatic than we saw last time, because, as I've said, last time there was resistance all the way down. There were people buying all the time because people will think, oh, it's so cheap and it hasn't been that cheap for so long and so on. This time it's just going to fall through the floor down to new lows where people start thinking like that again, starting to buying, because everybody knows how far it can fall very easily. We've been there. We was there just in March. So be prepared for some really scary scenario. And of course, the fact that the stock market is so high right now, it's much more dramatic than what it was last time, because the interest rate falling, taking down the interest rates by the central banks has been used up. They can only do that once. I mean, the Federal Reserve dropped interest rates down to zero, and pretty much everywhere else in the world has dropped it down to not zero, but close to zero. There's no more to give. So if we have a new panic day where the markets fall 5%, 10%, or even more, the central banks cannot counter that by going out and say, hey, we're dropping the interest rates by 75 points, as they did when the panic first arrived last year. They can't do that because that instrument has been used up. They got to come up with other things, and they will for sure. They're thinking about that right now, how to do that. They're going to start, what I believe is that they will start buying assets outright on the stock market. I mean, the Federal Reserve can just print money and buy anything. They can go out and buy shares directly on the stock market. Say the stock market falls broadly 10% in a day, new panic 15%. Ben Bernanke can go out and say, okay, we're doing $500 billion. We're buying equities. Buying shares on the stock market just like anyone else. They can do that. I mean, they bought up GM and they bought up, all kinds of corporations. They bought up Fannie Mae and Freddie Mac, and they're now doing, money to buy houses and mortgages directly. So they can do whatever they like. And of course, that will bring about a reversal in the markets. So expect some serious turbulence around the next down leg. Market's going to fall 5%, 10% in a day. Ben Bernanke is going to go out, okay, we're buying equities on Wall Street straight off the bat. We're just buying like everyone else. That's going to bounce the market up again. Say it goes up 5% again, or even in positive territory. I mean, if there's a floor here, if the Federal Reserve goes in and say, we're going to buy, then of course there's a floor. Dramatic things can happen. But they can't use the interest rate anymore for obvious reasons, because it's zero. What I should talk a lot more about is the inflation targeting of the central banks around the world, because the inflation targeting is like a mantra. It's like a truth, and it's part of the whole cover-up. It's part of the so-called central bank's independence, the Fed's independence. It's an instrumentation of this fraudulent policy of printing money out of thin air. Saying that we need a stable inflation, it's like cementing this fraudulent policy once and for all. And of course, when we take that as a given, then they can just do whatever they like, because that is a given, and the fundamental discussion underneath it is not taken anymore. So, the problem with inflation targeting is that whenever there is a readjustment in the economy, and we need readjustments from time to time, we could have a strong price increase, or we could have deflation, that prices go down. We just don't know that. There are real changes in the economy that happen from time to time. What happened during the 2000s was, of course, that Asia and China came to the markets and produced all this cheap stuff. So prices should have fallen because there was all this cheap stuff. But to counter all this cheap stuff coming in, the Federal Reserve started printing money. So we had this nice and even inflation, small inflation, and we had all over the Western world. Of course, in the U.S., it's not explicit like it is in Norway. It's actually explicit. 2.5% is the inflation target. And then they're wiggling at that for a little bit, exactly how the time frame when it's going to be happened and how it's going to happen, but 2.5% is their target, and they will go through hell and high water to achieve that, because 2.5%, that's their mandate. They called it their mandate, and there is their mandate. So they will crash the economy or unemployment or whatever to keep that 2.5 target. And the problem with that, again, is that sometimes the economy needs to readjust. Sometimes there are huge errors that need fixing. And sometimes prices need to rise, sometimes prices need to fall to enable that change. It's a fundamental change. I mean, if people all of a sudden went green and didn't want to consume anymore and didn't want to drive their cars and just pulled back and home gardening and people didn't buy stuff anymore, prices of stuff would fall dramatically. But maybe that's a good thing, let people do that. But no, the Federal Reserve and the central banks, they would never allow that, because prices are supposed to be stable. So if people change their consumption habits and what they buy, the Federal Reserve will counter that by printing more money and making sure this money flows out into the economy in order to increase demand and prices going up. So it's a perverse world. It's a perverse reality. The Federal Reserve and the central banks and the political establishment's grip on the whole thing, it's absolute perversion. What you have to do for your own sanity is to distance yourself from it any way you can. I mean, buying gold is one way to do that. If you have a gold coin, Ben Bernanke has no control over that gold coin, and neither does anyone else. You don't write it up in your declaration. You don't tell anyone you got it. You dig it down in your garden or whatever. It's total independence from the madness of the politicians. You have to do moves like that. Perhaps the most important thing is to get assets out of whatever country you're in, especially if you're in the USA. Get money out. Buy a house abroad or put money in a foreign bank account or whatever. Diversify yourself so you're not captive of one particular government. All right, that's pretty much all for today. I wish you all a happy Thanksgiving with your families or wherever you are in the world. I went down here to get some sunshine, to do some exercise, and go back to cold and freezing Norway later on to do more stuff. So thanks for watching.